Chris here from Project Option, and in this options trading strategies video, we're going to talk about the synthetic long stock position. So a synthetic long stock position is an option strategy that replicates buying and holding 100 shares of stock. So let's get into it. So let's look at the synthetic long stock strategy characteristics. So the synthetic long stock option strategy consists of buying a call and selling a put at the same strike price and in the same expiration cycle. The strategy replicates a position of owning 100 shares of stock with a potentially lower margin requirement. So one of the reasons you would trade a synthetic long stock position is because the margin requirement is typically less than a long stock position of 100 shares. So like a long stock position, the synthetic long stock position has unlimited profit potential, and to calculate the maximum loss potential, it depends on if you enter the synthetic for a debit or credit. So if you enter it for a debit, the max loss is the strike price plus the debit times 100. If you enter it for a credit, it's the strike price minus the credit times 100. Now the expiration break-even price, if you enter for a debit, is the strike price plus the debit, and if you enter it for a credit, it's the strike price minus the credit. Now, just like a long stock position, a synthetic long stock position has a probability of profit right around 50%. And since a long call and short put both expire to plus 100 shares of stock when they're in the money at expiration, a long synthetic stock position will also expire to 100 shares of stock at expiration unless the stock expires right at the synthetic stock strike price. So in terms of assignment risk, the short option in the strategy is the short put. So if the stock price falls significantly lower than your short put strike price, you are at risk of being assigned 100 shares of stock if you are assigned on that short put. So let's look at a synthetic long stock example trade. So from the following option chain, we're going to construct a synthetic long stock position. So let's assume at the time of these prices, the stock price is trading for $100. So to create a synthetic or a long synthetic stock position, we're going to use the 100 strike price. So to create the long synthetic, we're going to buy the 100 call for $3.53, and we're going to sell the 100 put for $3.44. Now that gives us a net debit paid of 9 cents, which brings our break-even price to the 100 strike price plus the 9-cent debit, which brings our break-even price to 100.09. So let's go ahead and take a look at the expiration risk profile graph for this position. Alright, so as we can see, the risk profile graph looks identical to the risk profile graph of a long stock position. So our break-even price is 100.09, and our worst case scenario is if the stock price goes to zero, in which case we would lose $10,009. So 100.09 times 100 is $10,009. Now if the stock price goes up to 125, we'll be up $2,491 because 125 minus 100.09 times 100 is $2,491. So basically for every 1 point increase or decrease in the stock price, the corresponding profit or loss will be $100. So let's go ahead and take a look at a real long synthetic stock position, and let's go ahead and see how that performs relative to an actual long stock position. Alright, so let's compare a synthetic stock position to a 100 share stock position. So the initial stock price is 109.82, and to construct the long synthetic, we're going to buy the 110 call for $4.13, and we're going to sell the 110 put for $4.28. So both options expire in 45 days. So since we collected $4.28 from the put and paid $4.13 for the call, we get a net credit of 15 cents, which means our break-even price is the strike price of 110 minus the 15-cent credit, which brings our break-even to 109.85. Our max profit potential is unlimited, and our max loss potential is 109.85 times 100, or $10,985, which occurs if the stock price goes to zero in the next 45 days. So let's go ahead and take a look at this position's performance through time. Alright, so in the top portion of the graph, we're looking at the changes in the stock price relative to the break-even price of the synthetic long stock position. Now, on the bottom part of the graph, we're looking at the profit and loss of the synthetic long stock position compared to a long stock position of 100 shares. Now, as we can see, these lines are right on top of each other, which means that the profit and loss of the synthetic stock position and the actual stock position are identical to one another. So, as the name suggests, a synthetic long stock position replicates actually owning 100 shares of stock per synthetic. So here we can just see that the option prices are very efficient, and using this option strategy properly replicates the risk and reward of buying 100 shares of stock. So let's go ahead and take a look at the summary of main concepts from this video. So a synthetic long stock position is a bullish strategy consisting of the purchase of a call and sale of a put at the same strike price and in the same expiration cycle. As the name suggests, a synthetic long stock position replicates buying 100 shares of stock. The maximum profit potential is unlimited, and one of the benefits of the synthetic long stock position is that the margin requirement may be less than buying 100 shares of stock. So the real benefit of trading the synthetic as opposed to actually buying 100 shares is that you might not have to put up as much money to get that exposure. Thank you so much for watching, everybody. If you enjoyed this video, please go ahead and subscribe to our YouTube channel so that you can be informed of all the releases of our future videos as they come out.